Hello and welcome to today's episode of Young and Visionary with me, Esnat Suleiman. In today's episode, I will be talking about when to borrow for investments. Now, there are a lot of successful investors who have managed to push their investments because of borrowing. This is not something that is completely new. We've seen it happen in the form of people getting a mortgage in order to buy a house. So you end up becoming a homeowner much sooner than you would have if you were to build the house organically. We've also seen people being able to get a loan for their education, which then the education helped them to get opportunities that they would not have been able to get without that education. So getting a loan for the purposes of investing in your own life is something that is not completely new. But when it comes to investments, this is a bit of a different type of field. There are a lot of successful investors that have really managed to grow their portfolios because they were able to get loans for their investments. However, we say that this is not a road for everyone. So today I just want to dive in a little bit deeper and talk about when you should actually borrow for investing. Now, to begin with, before you decide to get a loan for investing, you must ask yourself, what is your return and risk profile? So simply put, you should ask yourself how much risk you're willing to take and how much return you're looking to get. What are your investment objectives? Are you going to achieve your investment objectives with the loan or without the loan? A lot of people want a high return, but they're not willing to take the risk that comes with that high return. Now, borrowing for investment is considered to be an aggressive strategy. It's a highly risky strategy. The reason it's risky is because the loan itself has some risks that come with it, which is something that I will talk about. But even the investment that you're going to make may also have a risk that will come with it. So it's not the type of strategy that just any person can take. Usually it is advanced investors that actually engage themselves in borrowing for investing. So it's important for you to understand, are you a risk taker or are you risk averse? And then make sure that you align with who you truly are and what it is that you truly want to achieve. At the end of the day, you will have to pay off that loan, whether or not your investment performs. So why do people actually go through the trouble of getting a loan just to invest? Primarily, it's for two reasons. There's one set of people who are actually looking to accelerate the growth of their wealth. So by doing it organically, they know that it will take them a long time to grow their wealth. But if they can get a significant amount of money now to put in investment, it's something that will help them grow their wealth quicker. Another reason could be to diversify their investments. So, for example, you could be an individual that is holding a significant amount in one particular share. Now, you also want to diversify your portfolio, maybe buy other shares or maybe even buy government securities, but you don't have the money to do it. What do? You could take your existing shares and then get a loan against those shares. That loan is called a margin loan. So when you get that loan, you can then invest in other assets, and then you have a portfolio comprising of your current shares plus the new investment, and you can pay off your loan gradually. Now, the reason this could be a good strategy is because sometimes you do not want to sell off your existing shares, because that could be an option to say, if you're holding, for argument's sake, 10 million worth of shares, you could decide to say, I will sell off 5 million worth of shares, then I'll buy a treasury note or I'll buy shares in a different company. Instead of doing that, you could actually get a 5 million loan against your 10 million investment and invest in those other assets as well. And then you end up with a bigger portfolio, and then you can pay off your loan gradually. So while this may sound like a good thing, which it definitely is, there are some risks that come with it, which you should definitely consider. The first risk is the fact that interest rates could actually go up. So you have a plan, you've looked at your income and you've decided I could afford a loan of 5 million paid off over a period of 3 years at the current interest rates. And then you take that loan out, you buy, for argument's sake, shares, and then what you find is maybe a couple of months down the line, interest rates go up. If interest rates go up, then your repayment on the loan also goes up. You may not be able to afford that loan at the new interest rate, which then creates a problem for you. So that is the first risk. Interest rates could go up. The second risk is that your investment may not perform as well as you thought. So maybe you got a loan to buy shares because you thought the share price of that particular counter would go up. And then maybe over a period of a year, 2 years, the price remains constant, maybe even drops. Your investment has not performed the way you expected it to perform, but your loan remains. So you may have taken out a loan for 5 million, but your investment is now worth 4 million. At that point, you may feel like you have lost out, but that is a risk that you should be prepared for. You must be willing to take, and you must take out the loan knowing that that is something that could happen. For investors that are in it for the long term, oftentimes you do not worry about these short-term fluctuations in price because you know that you're in it for the long term and there will be sufficient time for the share prices to bounce back. Another risk that you could potentially face is what is called capital risk. So capital risk is where you actually lose your initial capital, and this could happen because of a number of things. First of all, it could happen because maybe you bought some shares and the prices of the shares have gone down, which means that your initial capital will have been lost. But however, it does depend on whether you are a long-term investor or a short-term investor. If you're a long-term investor, you do have time to recoup that loss should the price of that share go up again. Another reason that could happen is, for example, where you needed cash immediately. So you have an emergency and therefore you have an immediate need for cash. And you may be trying to sell off your investment right there and then. At times that people are desperate, you can find that maybe in the market, you do not have a willing buyer. And sometimes you have to take a knock on the price or reduce the price in order to find someone to buy the investment that you're holding. We've seen this even with houses where people are desperate to sell a house. They reduce the price just so a buyer will be found. It's the same with investments, whether they are shares, whether they are government securities. You may have bought it at a good interest rate. When you're selling it, someone will demand a higher interest rate than what you bought it at. So you will end up losing on the part of capital. And when that happens, then the loan would have worked, or not necessarily the loan, but the strategy of getting a loan to invest would have worked to your disadvantage. So what is it that we can do to mitigate the risks? First and foremost, make sure that the return that you're expecting on your investment is higher than the loan amount that you're going to get. This is a good rule of thumb in the sense that, especially where you're expecting to use your investment returns as a source of repayment for your loan. So you need to make sure that you've taken out a loan that has benefited you. If your cost, which is the interest that you're paying on the loan, is higher than the return that you're getting on the investment, you're actually making a loss. So as a rule of thumb, make sure that your investment returns are higher than the cost of the loan that you have taken out. Second thing is to make sure that you have an emergency fund. Now, the emergency fund is important, especially where you have other cash flow needs during the time that you have the loan. As I mentioned earlier, it may be difficult for you to access additional loans when you have used up your lending room or your borrowing room for this loan for investments. So in that instance, sometimes you're forced to sell off your investment so that you can pay off your loan, or you can get a bit of cash to use for other emergencies that may arise. However, if you have an emergency fund, then it takes away the need for you to quickly dispose your assets, because what happens sometimes is that there may not be willing buyers at the time that you need to sell your investment, especially when we're talking about certain types of shares. So in that case, we see people actually dropping the price quite significantly just so they can sell off the shares and meet their needs. But in so doing, you could end up actually losing your money. So you make a capital loss and then you still have a loan, but then you had to meet this repayment. So having an emergency fund is also something that will help you safeguard this investment strategy that you may have taken. Another thing that you could do is actually to make sure that you are earning enough regular income to repay the loan. So there are instances where you could actually take out a loan whose interest is higher than the return on the investment that you're going to make. But you only do this because from a strategic perspective, you feel that you must get into the investment at this particular time. For example, we know sometimes share prices go down, or maybe there are expectations that interest rates will go down. So you want to buy your asset while interest rates are high, or you want to buy the shares while the price is low. So you can end up getting a loan at this particular time, but you should make sure that your regular income will be able to meet the repayments on the loan, so that you can take the opportunity, even though the return initially is not, the expected return is not as significant, but your regular income can take care of the repayments. And once you have repaid, then your asset or the new investment that you may have acquired will have the opportunity to then realize the growth expectations that you had in mind when you went into the investment. Another thing that you could do is borrowing at a lower loan to value ratio. So what this means is at the time that you're investing, you could use a combination of your own funds and the loan to meet the investment required. But you should make sure that the proportion of your own funds is higher than the proportion of the loan that you're getting. In that way, whether there are fluctuations in the value of the underlying security, you know that the risk that you're taking is more on your own funds, and you still have enough to be able to pay for the loan amount. But in that case, like I said, for long-term investors on things like the stock market, you really need to be patient with the stock market. There are times when prices come down, but eventually prices can also go up depending on the prospects of the company. Finally, make sure that you diversify the investment. So one of the risks that I mentioned is the fact that you could actually lose your capital if share prices go down. However, at the time that you've taken out your loan and you're making the investment, you could diversify your investment across several investment vehicles, just to make sure that if one does not perform, then you're able to compensate with the one that did perform. So in that way, you cover yourself from a potential significant loss in the initial capital that you invested. And that concludes our episode of Young and Visionary. I hope that it has given you the clarity that you needed so that you could make the right decision whether to get a loan to grow your investments or whether to keep away from the loans altogether. It all depends on where you are in your financial journey, how much knowledge you have about investing, and of course, whether you have the capability to meet the repayments on such loans. Have a great day.